All right, looks like I've got a couple people. Omar, are you there?
How's it going?
All right, and I got Hala, I got you here.
Hi.
Hi. I'm going to go ahead and start. I know a couple people may not come today because they felt pretty confident with chapter 10. I went ahead and shared my screen. Can both of you see the Blackboard site?
Yeah.
All right, cool. Just a couple things just to remind you. Again, every Tuesday, Thursday, we'll be doing this. Next week, we'll be getting into chapter 11 on standard costing. Now, another thing I was going to show you is if you go over here to the left, and you'll see this link called Zoom meeting recordings. I'm going to click that. And that's where essentially, oh, I'm in the wrong class. Hold on just a second. I pulled up my wrong class. Let me go back to our class. That's my bad. Hold on just a second. There it is. All right. All right, so there we are. So go over to where it says Zoom meeting recordings. And after today's session, whatever we talk about, whatever I demonstrate, you have questions about, all this will be recorded, and then I'll link it back into Blackboard. So if you want to go back on your time and play it, or even next week, or as you're studying for the last exam, if you want to go back and look at a couple things, you'll have that as a resource. So I just wanted to show you that. Now, yesterday, I'm going to go to the learning modules. I sent you guys an announcement email. And I don't know if you guys have these up, but you may want to get this up today because I'm going to share my screen in a minute. You'll notice that I've got chapter 10 handouts. I'm going to look today. I'm going to focus mostly today on the flexible budget. So you'll notice that I've got a chapter 10 handout, flexible budget. I've given you the answer to it. And I'm going to bring up an Excel template that I'm going to work with you on this, just to kind of walk you step by step on how to calculate it. And, you know, anytime as I'm going through this, if you have a question or you have something you want to talk, or if I need to go back over something, just let me know. I know you've got like a chat feature and you can, or just speak up if you want me to go back over something. Okay, so I've got that. So I'm going to go ahead and I'm going to bring up, first of all, I'm going to bring up the handout. Let me get the handout. All right. So I'm not going to worry too much about that first one. Let me enlarge this a little bit. I trust that you guys can calculate ROI, return on investment, and residual income. Those are just some simple calculations, but you know, you've got the answer to that. And if you can't get it, let me know. I've given you the solution to that. I want to focus on this flexible budget idea. And you know, if we had a class session on this, I would have given this out to you. And then of course we would have gone through it just like I'm trying to do right now. But there's a couple of things I want to kind of emphasize with this. So we're going to look at first, I'm going to start with this problem 2. And they're giving us a flexible budget for different volumes of activity. We got 7,500 units, 8,500, and 95. And then we're going to do one on problem 3. We'll do another one. Okay. So here's all the data. This is in this format. And then, so what I'm going to do, and I've given you this template in Blackboard. I'm going to go ahead and pull up. This essentially is a template. I created this. I want you to take a look at this. This is essentially what's on that handout. Okay. And you'll notice, and I'm going to get my stylus on here just a second. Hold on just a second. I got to. Something's weird with my controls. It seems like when you guys log in, you should be able to log in automatically, but it still has you guys set where I have to admit you. I'd probably need to go back and change a function. I'll try to make sure I do that today. Christian just came in. All right, so I am going to talk about a couple things on here. So you'll notice this is what the problem's given us. This is problem 2. And I'm going to focus first on this first column where we've got the flexible budget. Let me change my stylus just a second. That came across kind of weird. Hold on just a second. Let me try that again. All right. So we had talked about the concept of cost behavior all the way back, I believe, even into chapter 1, where we talked about the concept of a total fixed cost versus a variable cost per unit and total variable cost. So in this particular problem, if we had this in class and I said, okay, guys, let's take a look at this table right here. And if you had to fill in the pieces, if you had to figure out for this problem, we've got sales units at 7,500, 8,500, and 9,500. And they've just kind of given you different pieces of the puzzle. And the objective of this problem is to really see if you understand the concept of cost behavior, because that's really a big part of this theme here. You'll notice on this column, I've got, it says flexible budget per unit, and they've given us a sales revenue per unit. Okay, so they've given that to us. So if you had to kind of go in this problem and I said, okay, could you fill in these pieces? Could you figure out, for example, per unit wise, what's my variable cost per unit? What's my fixed cost, and so forth? And that's essentially what we're doing in this problem. So take a minute, just think about this. So look at what they've given us. At 7,500 units, they've given us fixed cost of 80,000. And if you recall, this is a total fixed cost, right? So if I were to move over to 8,500 units or even 9,500 units, ask yourself this: what do you think the fixed cost would be for each of those volumes of activity?
90,000.
So if this is 80,000, remember that is a total fixed cost, right?
It would all be 80,000, right?
You got it. Yep, Omar, you got it. So that's part of what I like about this budget is it's really it's using some of your knowledge from the previous chapter. So let me go back to this. So because that 80,000 is fixed, at 8,500 units, you're going to have the same fixed cost. So that's going to be 80,000, and that's going to be 80,000. Okay. So, and that's just using your rules of cost behavior. We're assuming that 7,500, 8,500, and 9,500 are all within these, what they call a relevant range. Now, here's the next one to think about. So at 8,500 units, they've given us variable cost of $56,000. That is a total variable cost. So here's the deal. How could we figure out the variable cost at 7,500 units and the variable cost at 9,500 units? What are you going to have to do to be able to figure out those numbers? Anybody? Any guesses? Remember, we've got the total, right? We've got the total 56,000. That's your total variable cost. What would be your strategy to figure out your variable cost? I mean, just pick one. If we had to say, how would we figure out our variable cost at 7,500 units? What are you going to have to do? What do you think? So I'll pretend like we were in class if I was kind of waiting for a response. I'll give you a second to think about it. And again, don't feel panic if you don't know it, but think about it. Any ideas? Anybody? We know it's not going to be 56,000, right? So for example, at 7,500 units, we're not going to have the same total variable cost that we would have at 8,500 units, right? Does anybody know why? Omar, do you have any thoughts on that?
Sorry, my mic was muted.
Oh, I'm sorry.
Would it have something to do with sales revenue in that 23?
Well, that $23. Okay, well that $23, that is a per unit. That's sales revenue per unit, right?
Yeah.
So you're on the right track. What do we need to know for variable cost? Do we know the variable cost per unit? or I guess a better question would be, could we figure out what the variable cost per unit is? Focus, remember we look at this column, that's going to be the key right here in this column. What's our total variable cost at 8,500 units? 56,000, right?
Yeah.
What's our units? 8,500 units, right? So could we figure out our per unit variable cost at 8,500 units? And everybody's going to say what? Yes, right?
Yeah.
So if you did that, what would be your variable cost per unit at 8,500 units? You just have to divide, right? So you just take the take the 56,000, divide that by 8,500, and it's not going to be a rounded off number. I didn't make this problem up. If I made it up, I would have made sure all the numbers round off to a nice whole integer or something. This would give you right around 650. We'll call it 659. $6.59. So let me kind of make a note of that. And this, again, this is rounded to 2 decimal places, just so you know. So here's the deal. We know the rule about fixed cost. Total fixed cost, I just showed you, 80,000 is the same. It's constant for all these activity levels. That's a rule. We should also remember on our rules of cost behavior, a variable cost per unit is also constant, right? So if we know our per unit variable cost, and I'll just kind of pencil this in here at, we'll say it's what, 659, right? This 659, wouldn't that be true for all of these units of activities in terms of just the variable cost per unit? Because it is a variable cost per unit, the per unit is constant. So for each one of these, you're going to have 659, 659, 659. And so if we know those are your per units, can't we just take these costs per units and then just multiply by the units? That's pretty much what we would do, isn't it? I think that's what we did back in chapter 6 when we started to talk more in depth about cost behavior. And you do the same thing for the 9,500 units. Is everybody following me on that?
Yeah.
Is it kind of coming back? So to go back, the key is, and of course, if you were on a test and you were doing a quiz or something and you're getting nervous and you get a problem and you're ever asked to do anything about a flexible budget or anything about contribution margin, you need to think about, first of all, what do they give you in the problem? But you're most likely going to need to know what are your variable costs per unit, whether they give it to you or they don't give it to you. If they don't give you it, which they didn't in this problem, they did give us enough information to figure it out, which in this case would be right at 659. So at that point, you just take this variable cost per unit and then just multiply by these units. And then of course, that would be your total variable cost for each of those activities. And then at that point, it's just academic. You just have to add up they have a column here to say calculate total expenses. And then of course, we could then just take all of our revenues, subtract your expenses. And I guess one more thing, and then I'm gonna show you, we'll go over the solution to this. One more thing I just want to point out. And I'm just gonna go ahead and clear this now. The other thing, I think Omar, you kind of said it because you were on the right track with that. When they gave you this sales revenue of $23 per unit, right away, you know how to calculate the sales revenue for each of these activities, right? You just have to multiply. Just take 23 times 7,500. That's going to be your revenue for this volume, for this column. 23 times 8,500, you're going to put in your sales revenue there. And then again, multiply by 9,500 units. That's going to give you your sales revenue for that. So having said that, let me switch to, I've already kind of got this worked out for you. Of course, I've given you all these guys. So check this out. And again, this is kind of what I just talked about. And review this. Let's kind of go back over this. So I highlighted in green, that's your sales revenue. And of course, that's just taking your $23, which is your sales revenue per unit, and you're just multiplying that by your units. You got 7,500 units times 23 is 172,500. You then take this same number and multiply that by 8,500 units, you're going to get 195.5. And then do the same thing, multiply it by 9,500 units, and that's going to give you your sales revenue. Okay, so there's a lot of similarities between what we're doing right now and what you did in chapter 6 and 7 when you had to put together that contribution margin income statement or the variable costing income statement, whatever you want to call it, CVP. It's the same concept, because you have to know the rules of your cost behavior. And in this column, they gave you the per units. Now, I already just showed you how you got that 659, right? They gave you the 56,000. Let me go back. I'll come back to this in a minute. They gave you the 56,000. We divided that by 8,500 units. So that's how we would have come up with that 659. And by the way, I've got this in my Excel spreadsheet. So even though you guys see 659, I did not round that. So if you're going back home and you're doing this manually like on a calculator, and you just type in 6.59 times 7,500, just kind of show you this. So if you took 659 times your 7,500, you may not get exactly this number here if you're doing it on a calculator, because this number right here in Excel is not rounded. I left it as is. So you'll notice that it says it's what, 49,411 and 76 cents. You would get something pretty close to that. So in case you get confused about some of these numbers, if you're going back over them, don't panic about the rounding. Just make sure you understand the concept. Now, so in this solution, I'm trying to show you how you got the sales revenue. We then figured out our variable cost per unit, which is again 659. So this row right here is just taking this 659 and then multiplying by each of these volumes. Okay, so 49,411, 56,000, and 62,588. We already said the fixed cost is constant, so you notice we just copied the 80,000 for each column. And at that point, that's most of the puzzle, because what I highlighted in red here is that's just simply adding your expenses together. Okay, that's just your variable cost of 49,411 plus 80,000. That's where we got the 129,411. 56,000 plus 80 gives you 136. 62,588 plus 80 gives you the 142. And then once I did that, this last row right here, that's just taking your sales revenue, subtracting out your expenses. So the 43,088 is just 172,500, subtracting out the 129,411. Okay, so I put it in this format because that's how it was given in the handout. But on the next problem, I'm going to work with you. Most of the time, you're going to go back to your contribution margin format. That's what I would suggest you do, because I think that makes more sense. But, you know, in this case, if you look at it, it would make more sense if you were doing this internally to say sales minus variable cost is contribution margin minus your fixed cost would then give you your operating income. It's just a formatting issue. Okay. All right. So let me erase that. So you've got that. So let me go back. So again, this was from that problem 2 in that handout. And again, I think it's a good problem to even after today. And of course, you've got to get your My Accounting Lab homework assignments and quizzes submitted, by Sunday. This is still a good problem to go back and put it in your work papers as a good study guide, study material, specifically before that last exam. Okay, now this one is a little bit better, guys. This is problem 3. And of course, let me go back real quick. Let me show you the handout. And this is something that if we were in class, this is of course what I would try to tell you what to do or suggest. So they give you, here's the data. They give you, it says a company's flexible budget for 93,000 units of production showed sales of 300,000, variable cost of 150, and fixed cost of 90. Well, they didn't do this initially, but there's nothing stopping you from doing this. And that's how I approach the Excel solution to this, is I would just go back and say, I'm going to put this into a contribution margin income statement format. So what I mean by that is that's of course going to be your sales less your variable cost, remember, equals contribution margin less your fixed cost equals your operating income. All right. So in this problem, they've essentially given you a contribution margin income statement. They just didn't put it in that format. So when I go back to the Excel part, that's just taking all this data that they've given us up here, and I'm just going to reformat that into a contribution margin income statement. I think it's going to be a format that's going to make more sense to you. Now, once I do that, then here's the requirements of the problem. The problem says prepare a flexible budget and show the net operating income if the company produces and sells 98,000 units. And then I put in, 98,000 units is in the relevant range. So in this particular problem, we're going to show you two different income statements with the flexible budget, one at 93,000 units and one at 98,000 units. Okay. So having said that, let's go back. All right. So as you can see, I'm going to highlight this. Enlarge this. All right. So you'll notice I created a column called, again, flexible budget per unit. Here's your 93,000 units right there. And of course, you've got to figure out what it's going to be for 98,000. And I went ahead and I just plugged in the totals that were given. They gave you 300,000. They gave you 150 of variable expenses. And of course, 300 minus 150 is your contribution margin is 150. And then of course, you subtract out 90 and your operating income would be 60,000. That's pretty easy. You guys all can do that. So the question then is we need to figure out the same thing at 98,000 units. So take a quick minute and recall what I just suggested that we did. This was back on problem 2. What would be your first thing you might want to do in this problem to figure out how to fill out the column for 98,000? Anybody?
I would say fixed expenses, but I don't know if that really has anything to do with like sales revenue or variable expenses.
Well, we need that. So Omar, since you said that, here's my question to you then. If our fixed costs are 90,000, and that's at 93,000 units, what would be our fixed cost at 98,000 units?
Still 90, right?
Yep. Does everybody follow that? Does anybody not understand that? It's the same, isn't it? So that's one thing. So you already know your fixed cost. So that's pretty easy. So we got that. So that part's done. So now we just have to figure out these two pieces to the puzzle. How would we do that? Anybody? Any guesses? And I know some of you have your mics mute. If you wanted to chime in, that's fine. You just have to unmute it. But any guesses or any strategy on how we'd figure out the sales revenue or the variable cost at 98,000 units?
Should we find the per unit
Yep.
for the 93,000?
Yep, so that's exactly right. So let me change my stylus here. So yeah, so at 93,000 units, let me clear that and make it a little bit easier. At 93,000 units, can't we figure out our per unit for sales revenue and our per unit for variable cost? And the answer should be, of course, is yes. So what do we have to do? You take the 300,000, that's your sales revenue, and divide that by what? 93,000 units. You take the 150 and divide by 93,000 units. And of course, once you do that, that's going to give you your per unit for sales revenue and your per unit for variable cost. All right. Does that seem consistent? Does that seem very similar to the idea that we just did in the previous problem, everybody? Yeah.
It's a little different format, honestly, but it's pretty much seems like the same.
It is, isn't it? I mean, it's repetition. And here you go. And of course, I got this worked out. I don't want you to look at, of course, you're going to see the answer. Guys, just look at this column right here. Just want you to look at that. All right. And all that is the 323, that's just taking the 300,000, dividing that by 93. That's where we got that number. The 150 divided by 93, that's where we got the 161. Okay. And again, I just left it in its raw format. So having said that, let me go back. So again, that was just the problem data. So having said that, once we figure out these numbers, which again is our per units, we can then apply that at 98,000. And of course, that'll then help us figure out what our totals will be at the 98,000 units. Once we get those, we'll know how to figure out our operating income. All right. And so having said that, now I'm focusing just on the 98,000 units. And I pardon the fact that none of these rounded off to whole integers. It's just the way it's just the numbers they gave us in the problem. But this first one, this 316,129, that's just 98,000 multiplied by your 323. We're just multiplying it by that number right there. This 158,064, that's the 98,000 multiplied by the $1.61 in some sense. It's a continuous number, but that's how you do it. And this is just the rules of cost behavior. And so once we've done that, you'll note that you can then get your contribution margin. And of course, you already know your fixed costs. You just subtract those out. And of course, you would have 68,064 and 52 cents as your answer. And of course, you've got the solution to this already, but you know, as you use this as a base, it's a good problem to go back and study because it reinforces cost behavior rules. But now we're applying that within this concept of a flexible budget. Now, in a minute, we're going to go back in. I'm going to bring up a textbook problem, and we're going to then not only do this again, but then we're going to apply the concept of what do we do with it? So now that we've created this flexible budget, what is it for? So at that point, we'll take it and we'll compare it to actual results. And so we'll do a flexible budget variance, and then we'll also compare this to the master budget and come up with not only the volume variance, but the master budget variance. Now remember, the budget, it's always about, you know, assessing performance, comparing actual to some sort of budget to some sort of performance to assess how your company or your organization is performing. Okay. All right, so I'm going to leave this, but you guys have this. And so at that point, let me go back. They probably have already kicked me out of the, I had the textbook problem pulled up. Let's see if I can get it back in a minute. Let me go back. Yeah, give me a quick second and I will pull it up. And then we'll get into the textbook in a minute. Let me do this. Hold on just a quick second. There it is. I got it. Hey, it stayed on this time. Can you guys see that?
Yeah.
It says 1025A. Everybody got it? All right, so here's what I'm gonna do with this. So let's break this one down. So this is a good problem to kind of demonstrate everything you've got to do in terms of at least what I'm going to test you on, but also it covers most of the concepts in this chapter. And in this particular problem, I'll do a little bit of highlighting, and then I got an Excel spreadsheet set up for this already, and I'll walk you through it. But we've got, I'm just looking at our timer, right around 10:02. All right, so it says the Happy Balloon Company produces party balloons that are sold in multi-pack cases. The following is follows the company's performance report in contribution format. So they've already given us this spreadsheet. Notice we've got actual results, we've got a master budget, and then we've got a column that says master budget variance. Notice we've got in bold, actual number of cases is 60,000. The master budget is 55. Also note that we've got the total actual results right here. And we also have the master budget set up for us as well. Okay. Now, I'm not going to do this problem in the specific order they're asking, but if you look at the requirements, you'll note that they ask you to do, it says, for example, in part 1, what's the budgeted sales price per unit? Number 2 says, what's the budgeted variable expense per unit? Number 3, what is the budgeted fixed cost for the period? So these first 3 questions are going to be obtained by looking at this master budget column, right? So, for example, if we wanted to figure out the sales price per unit, and this is the budget, notice they gave us, in this whole spreadsheet up here, these are all totals. Nothing is in per unit format. So if we wanted to figure out our sales revenue per unit, wouldn't we just take 165 and divide that by the 55,000 units? Does that make sense to everybody?
Yeah.
I guess the better question is, does that not make sense? So you just take 165 and divide that by 55,000 units. And of course, that would be your sales price per unit. That's a budget number. That's not actual, that's budget. If you wanted your budgeted variable expense per unit, you would take the 88,000 and you divide that by 55,000 units. And then of course, your budgeted fixed costs are given at 68,000. So the whole point of this, I'm just trying to go back and reinforce this before we get to the problem, is that you're at this point, you're expected to know these rules of cost behavior, but that's just one thing. You also have to know how, when presented a problem like this, using a little bit of critical thinking, what tools do I need to do to be able to solve the problem? And most of the time, and I know I say this a lot in class, it involves simple math, whether you're going to be doing some division or multiplying. All right, that's about the highest level of math we get in accounting. Yet the math isn't the problem. The problem is the reading comprehension and understanding how to apply it. You guys might be experts in Excel, but if you don't know how to use that tool or why you use that tool, it's not really going to do you much good. So that's the beauty of the stuff I think in accounting. It really requires you to think about it. And you don't have to be a mathematician. You just have to know how to connect the dots, and you have to know how to think critically. Okay. All right, so here's what we're going to do. So we'll go back to this in a minute. I got a spreadsheet I'm going to pull up in a second, and we're going to walk through these numbers. So I went ahead and recreated this whole spreadsheet, and we're going to not only do this, but we're going to put together a flexible budget, and then we're going to do our comparisons. We're going to compare actual to flexible, and then we're going to compare the master budget to the flexible. So they've already given us 2 things. They've given us actual results, and they've given us a master budget. What they did not give us is that they did not give us a flexible budget. So our focus here, I'm going to circle this, we're going to do number 4 and number 5 kind of together. But when I look at number 5, I'm just going to kind of page down. They want us to prepare a flexible budget performance report at that 60,000 units, which is the actual results. Okay. And so once we do that, hold on, once we do that, then we're going to talk about some of these other things they're going to be asking in the problem. Like, as you can see, like if you read the problem, It says, for example, number 5 says management will like to determine the portion of the master budget variance that is due to volume, otherwise due to unexpected cost. We're going to do all that. We're also going to talk about, what happened. Why did we have more sales than in the master budget? Why is our actual revenue compared to the flexible budget? What should it have been? Because at this point, you might say, well, things look good, right? We had more sales. We had 60,000 units of sales versus 55. You're saying that's good because you had more expected sales. But guys, that's not the true comparison, because when we get down here, we've got operating income of 16,500 versus 9,000. Now, of course, if I were to ask you, is that good or bad? You'd say, well, I think that's good. And why would you say good? Because, well, you have more income than the master budget said you were expecting. But that's not an apple-to-apple comparison, because you have two different volumes here. The flexible budget is what we want to compare the actual to when we look at operating income, because what that's going to do is that's going to assess, the flexible budget is going to use the exact same volume here. And the flexible budget will say, this is what we expected the operating income to be. And then we'll figure out, how close were we to that and what are the differences? Okay. All right, so let's go to my spreadsheet if I still have it pulled up. I got it. All righty, so you'll notice a couple things. This was given in the problem. There's your actuals. And they also gave us the master budget. What they did not give us is, and notice the format that I put this in, here's your flexible budget column. We're going to plug in the numbers for the flexible budget in that particular column. Once we've done that, once we figured out everything in this column, I circle that, we'll know that, then we're just going to do our comparisons. We'll compare actual to the flexible, and we're going to call those our flexible budget variances. And then we're going to do our volume variance, where we're going to be comparing the flexible budget to the master budget. That's going to give us our volume variances, because they use two different volumes. And then the last thing we'll do is we'll do this thing called a master budget variance. That's pretty easy. All we're going to do with that one is we're going to compare the master budget to actual results and then put our differences there. So I wanted to walk you through this, because this problem really does pretty much all aspects of this chapter. Plus, I think it'll help you when you do your homework in my accounting lab. Okay. All right. Now, so let's go back for a second. So let's start. Your first order would be, let's figure out our flexible budget. So if I go back, and of course the problem had said figure out your sales price per unit and your variable cost per unit. So we need to go to our master budget, right? Go to your master budget. Your master budget says 55,000 units of cases sold, and they give us sales revenue of 165. So guys, what would be our sales price per unit at the master budget level? Did anybody happen to just calculate that real quick? You got 165, you got 55,000 units. Did anybody get a number?
3.
How much?
3.
Right at $3, right? Mm-hmm. So if our sales price per unit is $3 per unit, again, I'm just going to write this off down here below. Could we then figure out for the flexible budget what we think the sale, of course, well, let me go back. I guess I should have plugged this in. Remember, we're going to be using 60,000 units for the flexible budget. I should have kind of started there. That's probably the first thing I should have mentioned first. Just remember, guys, flexible budget uses the exact same volume as the actual result. So that's one thing that we need to know. All right, so we got 60,000 units. So if I wanted to figure out my sales revenue, wouldn't I just take 60,000 units and multiply that by 3? That would be reasonable, wouldn't it? So if you got 60,000 units and you multiply that by 3, I believe that gives you 180,000, right?
Yeah.
So guys, if that's not, so I'm just gonna, so let me clear this. So again, we're using 60,000 units. We just said that our budgeted sales price per unit for sales revenue is $3. That would tell us at the flexible budget level that we have sales revenue then of 180. Okay. Now, the next thing we want to do is let's just, again, I'm just want to fill in this column first, and then we'll go back and talk about some of the strategy here. So we've got $88,000 at 55,000 units. Could we figure out our budgeted variable cost per unit now? And of course, the answer is yes. So if you take 88,000 and divide that by 55,000, you get what?
1.6.
$1.60, right? So if that's $1.60, then could we figure out what the total variable cost would be for flexible budget? Again, we're using 60,000 units. You just take the 60,000 units and multiply that by $1.60, right? Anybody get it?
96,000.
Right at 96,000, right? Okay, so if that's 96,000, you got that. And then then of course, you could just subtract that from 180. You could then get your contribution margin. But then one more thing, fixed cost would be what? Well, 68,000, right? Because that's a budgeted fixed cost of 68,000. Okay. So once you got that, go back, you can now fill in this whole column. And the key is you needed to know these per units. All right. Notice everything in this column is in contribution margin format. Okay. So once you fill this out, I'm going to go to the solution, then we're going to talk about the comparisons. That's what you have to be able to do in this chapter. You may get some problems where they say prepare a flexible budget at a certain level of activity, something like that. And most of the time you'll be using the contribution format. And so if they ask you to do that, of course, you're going to need to know how to, that first of all, that the flexible budget uses actual results, which in this case is 60. And you notice how that's going to be different than the budgeted volume. So you got to really be on your game here a little bit when you're doing this budget, because what could happen is they're going to throw a bunch of numbers at you. They'll say actual sales, budgeted sales, and so forth. And you have to know what you use for the flexible budget. And the flexible budget in this case is going to be using 60,000. And then you fill in the rest of that. And then once you do that, it's just a matter of subtracting and taking the differences. And so to kind of make it more simple, I went ahead and I've actually already filled this in. So let's go to the solution to this. And to start with, I'm just going to focus on the flexible budget. I'm just going to focus on this column, and we're going to be comparing it to the actual column. That's what we're going to do first. So essentially, I'm going to walk you through right now and not only talk about the differences, but try to explain what we're looking at, what you would be looking at in terms of a variance, favorable or unfavorable, if you were like a manager. Okay. So let's start first with the sales revenue. And again, we're doing the variance column, so we're essentially doing the differences. So actual results are 185. Flexible budget says 180. Everybody sees that's a difference of 5,000, right? Does that make sense? Just take the difference. 185 minus 180 is 5,000. Here's my question to you, and I didn't plug this in intentionally. Would you say the $5,000 is good or bad? Is that favorable or unfavorable? What do you guys think?
I would say favorable.
That's favorable. And the reason that's favorable, think of it like this. The flexible budget is saying and let me change this format. That's my bad. Hold on. I just noticed something, guys. That's not 60,000. That's not 60,000 units. That's change that format. That's dollars. That's $60,000. That's not 60,000 units. Hold on just a second. Let me change that format for you. There we go. I didn't proof it. All right. All right. So at that point, that 5,000 is good because you're saying the flexible budget is saying we expect to have sales revenue of 180,000 using the actual number of sales. The actual result says we have a little bit more, which is good. We have more revenue than we had expected. Remember, the flexible budget, this is what you expect to happen using that same volume. That's why it's an apple-to-apple comparison. So this first one, you'd say favorable because you essentially charge more. So what do we say? $3 is the sales price per unit. And I think if you not notice off to the side here, let me show you something, and you'll see this, I think, later on. Off to the side, I went ahead and I put up all of the actual data per units over here as well. So I've got the budgeted per units, and I'm also showing you the actual per units. Notice the actual came up with right at 308, and the way I got that, that's just taking 185 and dividing that by 60. Okay, so I just wanted to also show that to you, that you might say, well, why did we have more sales revenue? And the reason we had more sales revenue is because obviously we charge more. We changed the sales price, you know, that happens. Okay. All right, so having said that, so let's go back. Change something on my view here. All right, so let's go back. And now let's look at the variable cost row. So our variable cost at the flexible budget was 96,000. The actual results say 99.5. So here's the question: this 3,500, guys, are we going to say that is favorable, or are we going to say unfavorable? What do you think?
Unfavorable, right?
Unfavorable?
Yeah, because we're over budget.
Yeah. So in this case, flexible said we expected to spend $96,000 on our variable cost. Actual says we actually spent 99.5. That's not good. So that would be an unfavorable variance, and you would have to go then and you want to investigate, why did we spend more? So this is where as a finance manager or a cost manager, you'd be trying to figure out what's going on in your workplace to figure out why did we pay more? Okay. So you would investigate that because the flexible budget says you should have been around 96,000. Now, of course, you subtract this, your contribution margin then is 1,500. You're still favorable on your contribution margin, the difference of 85.5 and 84, essentially because you charge more. It's all in that sales price. And then the last thing you look at is the fixed cost. You had budgeted 68,000. And then you actually incurred, it looks like it is 69,000. And of course, you would say unfavorable, right? Because you're spending more money than the budget. And of course, that could easily be explained. Maybe you had an increase in a salary, maybe there was a bonus, who knows? But just in terms of comparison, you'd say that's unfavorable. Now, at the end of the day, at the bottom line, this is a lot of times what managers first look at is what's our income? So actual was 16.5, flexible budget was 16. That's a difference of 500. Overall, you'd say favorable. And then the details would explain what is causing that up in this column right there. So even though you know overall you're favorable by 500, you can pretty much explain most of it. Most of the reason that you're favorable here comes back to that sales price, doesn't it? Because you had unfavorable variable cost, you had unfavorable fixed cost. So essentially your costs were going up, but you still had a favorable operating income. And the reason for it is most likely is because you had a higher sales price. But that's at least a part of your initial analysis as you're studying what's going on here. Now, once you do that part, then you'll notice, let me clear this. So now let's take a look at the volume variance. The volume variance is where we're comparing the flexible budget to the master budget. And you'll take a note here, they've got different volumes. So notice the flexible budget is using 60 and the master budget is using 55. So this first one right here, this $15,000 variance right here, you got sales revenue of 180 compared to master budget of 165. Of course, you know, we say this is favorable, but it's all volume based, right? All the differences in this column are based on volume. The only reason we have $15,000 as a favorable was because we had 5,000 more units of sales. So that's why this volume variance is a favorable variance. And then of course, your variable cost, you would say unfavorable. It's unfavorable, but because of this volume. So we're not really saying we're happy or sad. We're just explaining the differences between these two, how much is based on volume. This 8,000, we spent more in variable cost because we had 5,000 more units sold, okay? Now, so once you got that, the last thing I'm gonna bring up is the last column, which is how they come up with this master budget variance. All right, so guys, this master budget variance, and I'm going to use my stylus here. So first of all, this 5,000, we all know where that's coming from. That's just comparing the 5,000 here to the 60,000 actual. This 20,000, this variance right here, where we're comparing the master budget revenue, which is 165, we're comparing that to the actual revenue of 185. So we get a $20,000 variance. And of course, you would say favorable. But let me just stop on this point because I want to try to tie this together right here. Again, this is your static master budget that you compared to the actual. And of course, if we have more sales units, we know it's favorable. Master said 165, actual is 185. That's a $20,000 difference. You're saying favorable. But here's where the volume comes in. We're saying of that 20, we know that $15,000 of that is based on volume. Pure volume alone is explaining of this $20,000 variance right there. We're saying that the volume variance of 15,000 is explaining 15,000 of that 20,000. Does that make sense?
Yeah.
That's what the volume variance. It's basically saying the differences between the master and the actual. You know, here's your differences right here. But we also know, you know, apples to oranges, whatever. How much of these differences are based just on volume, and that's what this volume column is essentially doing for you. So if I went to the variable expense row, so notice we've got. Let me erase that because it's getting kind of crazy here. So if I'm comparing the master budget of 88,000, and I'm going to compare that to the 99.5, which is actual, that's 11,500 different, okay? Which of course you're going to say is unfavorable because you're spending more, right? But of that, we're essentially going to say how much of this difference is based on volume, and the answer is 8,000. So of this 11,500, we know that $8,000 of that can be explained simply just based on volume, which should be helpful to know. Then the other 3,500 is something else. So this is going to help you narrow your search. If you're, you know, if you're a manager and you're doing some thinking, you want to say, well, what do I need to be focusing on? Well, the volume is going to take care of $8,000. Now you need to focus on the other part to figure out what's happening on the other end. Okay, so that's what that works. That's how that works. All right. And then the last part, the last thing you're going to be comparing here is we've got the 68,000 that we're going to compare to the 69,000. And of course, that's a $1,000 difference. And of course, like I said, there's no volume on that one. That difference is going to be, you know, typically you look at fixed cost as more of an independent variable, not a dependent variable. And so that $1,000, whatever reason's causing that is going to be the same reason that's going to cause this one. So when you compare actual to flexible, this difference right here should be the same as this one. And the reasons are going to be exactly the same. The only place where the volume variances come into play is with the sales revenue and your variable cost. Okay. So to go back, now, of course, they didn't give you this whole template to begin with. I just I plugged this in. If you go and check out your answers, your answer solution in Blackboard, this essentially is what they're going to give you, but they'll also plug in, I think, whether these are favorable or unfavorable. Okay. But in the actual problem, of course, they just gave you, like I said, they just gave you the actual, and they gave you the master budget. Okay. But having said that, the format is exactly the same. And for you guys, it's just a matter of filling in the tables. Think of it kind of like a table. And you all know, if you had this like on the job, you would already have a spreadsheet created or something set up already, and you'd be plugging these numbers in, and then of course, plugging in your formulas, and then of course, doing your analysis. Okay. All right. So that would be that one. Let me go back. So this was, again, problem 10-25A. And if I feel like if you can handle this problem, if you can get this problem down and you know how to get the flexible budget, and you look at these comparisons and these illustrations that I just showed you, I believe you should be okay when you start to practice and start to submit your accounting homework problems in my accounting lab. I believe you'll get it. Okay. Now, are there any, so let me stop. So I've covered, my notes, I wanted to make sure I covered that part with you. Are there any questions? Is there anything else you want me to go? There's one more problem I'm going to kind of put up here in a minute. But were there any issues? Does it make sense, the stuff I just showed you? And I know since I'm recording this, I want to have something that you can go back to and, very linear. You can check it out and take some notes on it again if it helps you. But I don't know if this is helping any. But I hope you're seeing that a lot of the stuff in this chapter, I think, Omar, you said it, a lot of the stuff in this chapter is pretty much the same stuff we've been doing.
Yeah.
Really since chapter 6, I believe, when we started to introduce the concept of cost behavior. Because guys, this is a contribution margin income statement right there.
Now that we do it together, it makes sense. I really only had a problem before with the per units, but it makes sense to me now.
And the kind of interesting thing about this stuff, if we had, and I'm not trying to say that, it's not good to actually be in a face-to-face setting, but if this is helping at all, here's the deal. You can go back, because since I'm recording this illustration, and call it a demonstration, we don't do this face-to-face. Once our face-to-face class ends, nobody's recording our lectures on campus, but I'm essentially recording everything I'm doing right here. So this is kind of like live. It's almost like I'm recording our classroom. So this, actually is a benefit. I think in a way it's a benefit. Maybe one of the advantages of not actually being in class, because we're actually videoing this. So I don't know. I mean, that's, again, it doesn't take away. It's always better to have a face-to-face, because you can redirect, and you may feel more comfortable with asking questions. But I was thinking about this other day, the fact that everything I'm doing in here, I'm recording. I'm giving you another lecture essentially, and this is a lecture that you can go back, and now that you've seen it, you visually have seen it, you can go back and rework it, and kind of, Omar, like you just said, I think it might even help reinforce some of the other stuff you've been learning throughout the semester. Okay, so let me go back, and I know we got about 15 minutes, but this is back to your textbook problems. So this is 10-25A. And just to kind of make a couple more notes on this, so you can see how we did everything in this problem. We've done all the calculations. So at that point, what you can then do is you can then go back and see if some of these questions make sense, like on number 6, it says, using the flexible budget performance report you prepared for requirement 5, answer the following questions. And then, of course, I keep changing my mouse so I can scroll down. All right. You can then try to go back and figure out what are the answers to part 6. Part 6 is really just kind of like, you can look at that part as just really the analysis. And I've actually, if you go back and watch this video, I've actually already talked about all these answers. I did it in verbal format, but I actually already mentioned what the master budget variance does and how much of the cost are due to the volume and so forth. All right, so That part, I walked you through as I just illustrated, but that's what that part would be. That's of course what we would have done, try to do in class, just to kind of sit back and say, do the numbers make any sense? All right. Now, another one, let me clear this. So that was 1025A. Here's another one, and I'm not going to even attempt to do all this one with you right now, but this is another good problem to kind of take a look at, and whether you do it or not, I feel like it's a good one, because I know you got to submit a bunch of these assignments in your My Accounting Lab, but this is a good one. It's just 1026A, and I'll just kind of at least give you the setup and then just talk. It's a long problem, and I'm not even going to try to put this one up today, but this would be a good one just to kind of test yourself to see if after the stuff I've just talked about today, to see if you could actually do it. So let me just show you a couple things of what they give you, just in case you're going to try that. I know we got looks like about 13 minutes left, or 12 minutes left. So we've got, it says, Main Street Muffins sells its muffins to restaurants and coffee houses for an average selling price of $26 per case. It says the following information relates to the budget for Main Street Muffins for this year. So like I tell you in class, you've got to kind of watch out to how they separate the data. So everything they're giving you right here, notice, budgeted sales, that's a budget. Packaging cost per case, shipping expense per case, sales commissions expense, all right? So here's the deal. If you were approaching this, you would need to know that, of course, that is a variable cost. That's a variable cost, and that's a variable cost. And I know I'm doing this kind of quickly with you, but how do I know that those are variable costs? Because it says per case. And of course, sales commission expense, this is 5% of whatever that sales price is, okay? And so then the rest of this, as you would be practicing this, you need to know that the rest of these, again, notice all I'm doing here is I'm just identifying what my costs are. You've got salaries expense, office rent, depreciation, insurance, office supplies. You're going to classify these mostly as fixed. Now, I would most likely have a problem with that one, but it's a textbook problem. That's how they're wanting you to look at it. Most of the time, I would never say office supplies expense is a fixed cost, but they're essentially wanting you to say these are all fixed types of costs. So that's one thing you would have to know to figure out as you're working this. I think that would be a good way to kind of organize the problem. But the other thing I'll mention is this first group of data is all your budget, okay? Then they give you a second group of data, and it says during the year, Main Street Muffins actually sold 9,500 cases. Again, notice you've got actually sold 9,500 cases, resulting in total sales of 255.2. Actual expenses are as follows. Everything here is actual, okay? So once you see that, so you've got two groups of data here. You've got a budgeted, here's your budget, and then here's your actual results. Notice they didn't put any of this into any sort of format. They just listed your cost and they listed your sales revenue. And so if you were to go down and say, it says construct a flexible budget performance report for Main Street Muffins for the year. Be sure to indicate whether each variance is favorable or unfavorable. So this problem wants you to do a flexible budget. And when you go, if you want to practice this one, what you would want to do is put all of this into that contribution margin format, meaning sales, you have your variable cost, get your contribution margin, and then subtract out your fixed cost to get operating income. When you go, if you do this, when you go and look at your solution manual on this problem, because it's a long, if I were to try to work this out with you right now, it might take 20 minutes. I'm just trying to give you the setup here. I think it's a good problem to go back and practice. That's why I'm not doing it. But my point is I'm trying to give you some strategy here. So for the most part, anytime they ask you to do, most of the time they ask you to do a flexible budget, income statement, whatever like this, you want to follow the contribution margin format. And in this problem, you note they're expecting you to know what fixed costs are, how to recognize those, how to recognize variable costs. And so that's why I just did that up when I showed you the budget. When I start to see everything they give you right here, you know, they didn't just, you know, chapter 6 and 7, they just said, here's your variable cost. Here's your variable cost per unit. This chapter says, okay, here's your packing cost, but it states it as per case. So that's why I'm saying you need to be able to recognize that that is a variable cost per unit, just like the shipping is, just like the sales commission is. And like I just tried to show you today, if you know your variable cost per unit, you should be able to apply that to then get your total variable cost. And of course, here's your fixed cost down here. All those are your fixed. And then of course, you've got, don't forget about this, the 9,100, that's your budgeted sales. But here's where the thing where a lot of people mess up. If we had 50 minutes in class and I were to say, let's put this together, here's where people are going to get a little confused is I told you, they do this a lot, is you've got budgeted sales cases of 9,100, and then you've got actual cases, you've got actual cases sold of 9,500. Now, the problem says prepare a flexible budget. So if one thing hopefully you've learned today, and here's the little quiz I'm going to ask you guys. So we've got budgeted units of 91. We've got actual sales units of 9,500. If you were to then go and prepare a flexible budget, they don't want the master budget, they want the flexible budget. Here's the question. Which volume would you use? Would you use 9,500 cases or would you use the 9,100 case? Which one would you use? Again, this is for the flexible budget. What's the volume that you're going to use? Anybody? Any guesses?
Would it be 9,500?
Yeah. Everybody say 9,500?
Yeah.
It should be 9,500. Because that's actual. You always use the actual number in this flexible budget, report. Because at some point in time, you would want to compare that flexible budget to the actual, but the flexible budget always uses the actual results. The budgeted number, just to go back, the budgeted number that they gave you in this problem of, what is it, 9,100 cases? You don't really even need that in this problem. They gave it to you, but you don't even need this, okay? Now, having said that, that's how you do the flexible budget. But I want you to think about a couple things. I was trying to show you today, and I think it's going to be really big next week, if you guys need some help next week when we get into chapter 11. Here's how you have to approach most of these problems is they're going to give you lots of times extra information, and you're going to have to figure out what you need versus what you don't need. And you know, one thing I will tell you next week is we're going to be getting into this thing called standard cost. Standard cost is where you have actual results you're comparing to some sort of standard. A standard is a budget number, but it's a budgeted number stated like as a per unit. And it's where you're assessing performance. We're going to look at material variances. We'll look at labor variances, overhead variances, and so forth. And it's fairly easy to kind of lose track of what you're comparing. And so, like we did here in the flexible budget, we'll compare actual results to the flexible budget. When we get into the next chapter, we're going to do something almost identical. We'll be comparing actual results to a standard cost. And the standard cost is going to work just like a flexible budget. You'll see that next week. It's the same idea. But because of that, what they're also going to do in the next chapter is they'll give you just like the master budget kind of information as well. And sometimes you need some of that stuff and sometimes you don't need it. And that's going to be the trick to the next chapter. And that's why when I went ahead and when I did a revision of our class schedule, knowing that we wouldn't be able to meet face to face anymore, I initially thought, you know, I need to give you at least a couple weeks with chapter 11, because I just didn't feel like 1 week would be fair to you, because there's a lot of different little, I have a unique way of, I'm going to show you how to work a problem. I have a little template that I work out when I do it. And there's some trick, I'm going to say tricky, but you just have to really read these things carefully. So that's why, if you wonder why, when I had to do the, the schedule revision, I had to cut one of the chapters. I didn't want to do that, but I didn't, if I had to cut something, I cut the one chapter that's not really required. It's the chapter 12. The chapter 11, generally would probably take us, even if we were meeting face to face, would generally take us probably 3 class meetings. So that's why I did it. That's, I had to do something, because, with this pandemic thing, I had to do something. So, but if you've been paying attention to what I showed you today, and thinking about how the flexible budget works, and you do your homework this week, get your quiz submitted by Sunday. Next chapter, when we start to do standard costing, I'm going to try to emphasize that there's a lot of similarities between comparing actual results to a standard cost as we're comparing actual results to a flexible budget. It's very, very, very similar. And it's very similar because you need to think about the flexible budget is what you expect to happen, and the actual result are what actually happened. And if you're running a business, you always want to beat the budget. You want to have more sales. You want to have less cost. You want to have more money. Okay, and that's just basically how it works. Okay. All right, so everything, I got about a couple minutes left. Everything I've shown you today, it's recorded, and I'll get this posted up in Blackboard later today. So that's kind of like a nice little thing. I just recorded my little class lecture again. And, if we had a face-to-face meeting, although I think the face-to-face is still better, we wouldn't have had a recording. So if you ever want to go back over a live lecture, you can do that in this setting. You just can't do that in a face-to-face. So I'm not trying to be a proponent and say, hey, look, I'd rather have this. Of course, I'd rather be in a classroom, but I'm just trying to say that I think there is some benefit, there is some advantage to having this, because now you can kind of go back and play it again. And if it made any sense to you, I think it'll be at least a little bit helpful than just playing my recordings without having any context. Okay. All right, guys. So we got about a minute left. Any issues? I know we got a minute left. If anything at all, I don't know if this is helping any. I hope it helps. What is today? Today's the 23rd. I think, is that right?
Yeah.
Today's the 23rd. And if I look at our calendar, let me look. So we got next week and the week after. So after this week, this is crazy how time goes. My time isn't normal at home because it's different when I go into the office. So we really have 2 weeks of class. After this week, we have 2 weeks left. All right. And then you'll have your test will be the week after that. It'll be in my accounting lab again. So prepare this week, finish up your chapter 10 work. Don't forget about that project. I know I didn't mention that, but make sure you get your project submitted. And we'll spend the next 2 weeks then looking at chapter 11. And then to wrap it up the semester, your exam 3 will just be over chapters 10 and 11. Okay. All right. Email me. Let me know if you need something. If there's a specific thing you want me to go back over even next time, I can do it. But if you don't let me know, then I'll just, like I tell you in class, if you don't raise your hand, if you don't ask a question, then I'll just keep moving on. But let me know if you struggle with something, I'm here to help. So, all right, guys, I'm gonna go ahead and wrap it up. Any final thoughts?
All
Thank
good
you.
over here. Thank you.
Thank
Is that
you.
helping? Is this something that you guys like? Is it helping you a little bit?
Yeah, I
Yeah.
do enjoy this a lot more than.
I apologize for not having this set up the week after everything got started. I was busy converting a bunch of files. My first thought was when they changed everything to online, I thought, you know what, I need to revise some of these illustrations. So my computer took me forever to get all your recordings into the MP4 format. But once I got that done, I was doing that for all my other classes. And I had never even heard of Zoom before my kids that helped me, all the kids, the public schools are closed. My kid's school was using it. And then I had some colleagues that kind of emailed me, said they're starting to use it. So then I said, you know what, I'm going to try it as well. And so when I tried it as a trial, it was very easy. So I did a little training on it and I said, okay, I'm going to try this. And so this is the first time, your class and my other class, this is the first time I've ever really done any sort of live virtual instruction. So I'm going to have some hiccups along the way, and I'll figure out what works and what doesn't work. But at least I'm feeling that if this happens again, and based on what they're talking about in the news with coming, of course, summer's all online, but if the fall is, we're still trying to schedule face-to-face courses in the fall. What's to say they might just convert all those to online? I don't know what's going to happen, but at least at this point, I have a tool I can use to kind of give you some live instruction, and I kind of like it. So, but of course, I'd rather be in the office. So, all right, so I'll wrap it up. Let me know if there's any questions, any issues. Just send me an email, and we'll meet again. If you need to meet with me, we'll meet again the same time on Tuesday next week. And like I said, we've got 2 more weeks of these, and then we'll have our exam 3. Okay, guys?
Okay,
See you next
thank
week.
you.
All right, have a good one. See you guys later.